Look, I need you to pay very close attention to what I'm about to share with you because what's unfolding right now in the gold and silver markets isn't just another price movement. This is the kind of setup that comes along maybe once in a generation, and the people who miss it are going to be the ones asking themselves how they didn't see it coming. Right now, as I'm recording this, gold is trading near all-time highs, and silver is starting to wake up from what's been a multi-year slumber. But here's what most people don't understand. What you're seeing on the surface is just the tip of the iceberg. Beneath the headlines, beneath the price charts, there's a structural shift happening in the global financial system that's going to catch millions of people completely off guard. Let me paint you a picture of what's really going on. For decades, the Western financial system has operated on a very specific set of assumptions. The dollar is king. Treasury bonds are the safest asset in the world. Gold is a barbarous relic. These weren't just beliefs, they were the foundation of how global finance worked. But something fundamental has changed, and the cracks in that foundation are starting to show. Central banks around the world are buying gold at a pace we haven't seen since the 1960s. And I'm not talking about small purchases here and there. I'm talking about systematic, aggressive accumulation. The People's Bank of China has been adding to their reserves month after month. The Reserve Bank of India is buying. Poland, Singapore, Turkey, they're all loading up. Even central banks that historically held very little gold are suddenly becoming major buyers. Now, you might be thinking, okay, central banks buy gold, so what? But here's the thing. Central banks don't make emotional decisions. They don't buy assets because they're excited or scared. They buy assets because they see structural problems coming, problems that require real, tangible reserves. And when you see this kind of coordinated buying across multiple countries, across different political systems, across different economic philosophies, you have to ask yourself, what do they know that the average person doesn't? Let me take you back to a moment in history that most people have forgotten. In 1971, President Nixon closed the gold window. Up until that point, foreign governments could exchange their dollars for gold at a fixed rate. But the United States had been printing so many dollars to fund the Vietnam War and domestic spending programs that foreign governments started to get nervous. France, under Charles de Gaulle, actually sent a warship to New York to pick up their gold. They didn't trust paper promises anymore. They wanted the real thing. Nixon's decision to close the gold window was supposed to be temporary. It's been over 50 years, and we're still waiting for that window to reopen. But here's what happened after 1971. Gold went from $35 an ounce to over $800 by 1980. That's not a typo. Gold went up more than 20 times in less than a decade. And the people who saw it coming, the people who understood that the monetary system was fundamentally changing, they protected their wealth. The people who didn't, they watched their purchasing power evaporate. We're in a similar moment right now, except the stakes are even higher. Back in 1971, the dollar was still relatively strong. American manufacturing was still dominant. The United States was still the world's largest creditor nation. Today, we're the world's largest debtor nation. We've got over $34 trillion in national debt, and that number is growing by trillions every single year. The interest payments alone on that debt are now larger than the entire defense budget. But here's where it gets really interesting. For years, the United States has been able to run these massive deficits because foreign countries were willing to buy our treasury bonds. China, Japan, Saudi Arabia, they all held trillions of dollars in U.S. debt. It was a system that worked as long as everyone played along. But something has shifted. China has been quietly reducing their treasury holdings. They're not dumping them all at once, that would crash the market, but they're slowly, methodically moving away from dollar-denominated assets. And what are they buying instead? Gold. Lots and lots of gold. Japan, which has been the largest foreign holder of U.S. treasuries for years, is starting to face their own crisis. Their currency has been weakening, their debt-to-GDP ratio is over 250%, and they're running out of options. If Japan ever has to start selling treasuries to defend their currency or fund their own deficits, that's going to send shockwaves through the global financial system. And then there's the BRICS nations: Brazil, Russia, India, China, South Africa. For years, these countries have been talking about creating an alternative to the dollar-dominated financial system. Most people dismissed it as talk, as posturing. But they're not just talking anymore. They're building infrastructure. They're creating payment systems that bypass the dollar. They're settling trade in their own currencies. And at the center of all of this is gold. Russia, after being hit with sanctions, has been one of the most aggressive buyers of gold. They've been converting their dollar reserves into gold as fast as they can. They understand that in a world where your assets can be frozen with the stroke of a pen, physical gold is the only thing that can't be taken away from you. It's not in someone else's banking system. It's not dependent on someone else's goodwill. It's real, it's tangible, and it's yours. Now, let me shift gears for a second and talk about something that's directly relevant to a lot of people watching this. If you're sitting on a significant amount of money in retirement accounts, if you've got $100,000 or more in IRAs or 401ks, you need to understand how vulnerable those assets are to what's coming. Most retirement accounts are heavily weighted toward stocks and bonds, assets that are denominated in dollars, assets that are going to lose purchasing power if we see the kind of monetary crisis that's brewing. I put together a free guide that walks through exactly how gold IRAs work, how you can get physical gold into your retirement account without triggering tax penalties, and what you need to know before making any moves. It's in the description below. I'm not saying everyone needs to do this, but if you're in that situation where you've got substantial retirement savings and you're worried about what's coming, it's worth understanding your options. Take a look at the guide. See if it makes sense for your situation. All right, back to what's happening in the markets right now. One of the most important things to understand about gold and silver is the difference between the paper market and the physical market. When you see the price of gold quoted on financial news, that price is being set in the futures market, specifically on the COMEX in New York. But here's the thing. The COMEX is primarily a paper market. Most of the contracts that trade there are never intended to result in physical delivery. They're just bets on the price. The problem is that the amount of paper gold trading on the COMEX is vastly larger than the amount of physical gold that actually exists to back those contracts. It's like a game of musical chairs, where there are 100 people but only 10 chairs. As long as everyone doesn't try to sit down at the same time, the game keeps going. But the moment people start demanding physical delivery, the whole system breaks down. And that's exactly what's starting to happen. We're seeing signs of stress in the physical gold market. Premiums for physical gold coins and bars have been elevated for months. Delivery times are getting longer. Refineries are running at full capacity and still can't keep up with demand. The Shanghai Gold Exchange, which is a physical delivery market, has been trading at a premium to the COMEX price. That's not supposed to happen. In a normal market, prices should equalize through arbitrage. But when the physical market is trading at a premium to the paper market, it's telling you that people value the real thing more than the paper promise. Silver is even more interesting, and frankly, more explosive. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. About half of all silver production goes into industrial applications. Solar panels, electronics, medical devices, electric vehicles. And here's the kicker. Most of that silver is used in such small quantities per product that it's not economically viable to recycle it. It's gone forever. At the same time, investment demand for silver has been surging. Silver ETFs have been seeing massive inflows. Retail investors are buying physical silver coins and bars at record levels. And just like with gold, central banks and sovereign wealth funds are starting to look at silver as a strategic asset. The supply side of silver is even more constrained than gold. There are very few pure silver mines. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. So if those base metal mines slow down production because of low prices or economic weakness, silver supply drops too. We're already seeing this happen. Several major silver-producing mines have announced production cuts or delays in expansion projects. Now, let's talk about what happens when you combine surging demand with constrained supply in a market that's relatively small. The entire global silver market is only about $25 billion a year. That's tiny. Apple makes more profit than that in a single quarter. If even a small fraction of global investment capital decides to move into silver, the price impact is going to be enormous. There's a historical precedent for this. In 1979 and 1980, the Hunt brothers tried to corner the silver market. They bought massive amounts of physical silver and silver futures contracts. At the peak, silver went from around $6 an ounce to over $50 an ounce in just a few months. Now, the Hunt brothers eventually got crushed because they were using leverage and the exchanges changed the rules on them. But the point is, silver is a small enough market that concentrated buying can move the price dramatically. Imagine what happens if a sovereign wealth fund, or a group of central banks, or even a coalition of wealthy individuals decides they want to own a significant portion of the world's silver supply. The price wouldn't just go up, it would explode. And unlike the Hunt brothers, sovereign entities don't have to worry about margin calls or rule changes. They can just buy and hold. Here's another angle that most people aren't paying attention to. The energy transition. Governments around the world have committed to massive investments in renewable energy, electric vehicles, and grid infrastructure. All of this requires enormous amounts of silver. A single solar panel uses about 20 grams of silver. An electric vehicle uses about 30 grams. Multiply that by millions of units per year, and you're talking about hundreds of millions of ounces of additional silver demand coming online over the next decade. But here's the problem. The silver mining industry hasn't been investing in new production. Why? Because for years the price of silver has been too low to justify the capital expenditure required to bring new mines online. It takes 7 to 10 years to go from discovery to production for a new mine. Even if mining companies started investing heavily today, we wouldn't see that new supply until the early 2030s. In the meantime, we're going to have a supply deficit that gets worse every single year. Let me give you a specific example of how this is playing out. There's a major solar panel manufacturer that recently announced they're having trouble sourcing enough silver to meet their production targets. They're not alone. Multiple companies in the solar industry are starting to sound the alarm about silver availability. Some are trying to develop silver-free solar panel technology, but that's years away from being commercially viable at scale. In the meantime, they need silver, and they're willing to pay higher prices to get it. Now, think about what this means for the price. If industrial users are competing with investment demand, and both are competing with a limited supply, the only way the market clears is through higher prices. Much higher prices. We're not talking about silver going from $25 to $30. We're talking about silver potentially going to triple digits. And if we see the kind of monetary crisis that's brewing, where people lose faith in paper currencies, silver could go even higher than that. Let's zoom out and look at the bigger picture. What we're witnessing right now is the slow-motion collapse of the post-1971 monetary system. For over 50 years, the world has operated on a system of pure fiat currencies, backed by nothing but government promises and military power. That system worked as long as people had faith in it, as long as governments exercised some degree of fiscal restraint, and as long as there was no viable alternative. But all three of those conditions are breaking down. People are losing faith in fiat currencies because they can see their purchasing power eroding in real time. Governments have completely abandoned fiscal restraint, running deficits that would have been unthinkable a generation ago. And alternatives are emerging, whether it's gold-backed trade settlements, cryptocurrency, or bilateral currency agreements that bypass the dollar entirely. The United States has weaponized the dollar through sanctions, and that's accelerated the move away from dollar dependence. When Russia was cut off from the SWIFT payment system, it sent a message to every other country in the world. If you rely on the dollar-based financial system, you're vulnerable. China saw that. India saw that. Saudi Arabia saw that. And they're all taking steps to reduce their exposure. Saudi Arabia, which has been the cornerstone of the petrodollar system since the 1970s, is now accepting payment for oil in currencies other than dollars. That's a seismic shift. The petrodollar system was the mechanism that created global demand for dollars. Oil-importing countries needed dollars to buy oil, so they held dollar reserves and bought U.S. treasuries. If that system breaks down, the demand for dollars drops, and the value of the dollar drops with it. What does that mean for you? It means that everything priced in dollars is going to get more expensive. Food, energy, imported goods, all of it. Your paycheck might stay the same, but it's going to buy less and less. This is the hidden tax of inflation, and it's the most regressive tax there is because it hits the people who can least afford it the hardest. Gold and silver are the way you protect yourself from this. They're not investments in the traditional sense. They're insurance. They're a store of value that maintains purchasing power when paper currencies lose theirs. Throughout history, every single fiat currency has eventually failed. The average lifespan of a fiat currency is only about 27 years. The dollar has lasted longer than most, but that doesn't mean it's immune to the same forces that have destroyed every other unbacked currency in history. Let me tell you a story about what happened in Weimar Germany in the early 1920s. Germany had lost World War I and was saddled with massive reparation payments. The government started printing money to pay those debts and fund domestic spending. At first, the inflation was manageable. Prices went up, but people adjusted. But then, it accelerated. By 1923, the German mark was completely worthless. People were using wheelbarrows full of cash to buy a loaf of bread. Life savings were wiped out overnight. But here's the interesting part. The people who owned gold and silver came through that crisis relatively unscathed. While paper marks became worthless, Gold and silver maintained their value. You could trade a single gold coin for months' worth of food and supplies. The people who had the foresight to convert their paper wealth into hard assets before the crisis hit were the ones who survived with their wealth intact. We're not in Weimar Germany, and I'm not saying we're going to see that level of hyperinflation. But the principle is the same. When faith in a currency breaks down, people flee to real assets. And the most liquid, most universally recognized real assets are gold and silver. Here's what I think is going to happen over the next few years. We're going to see continued pressure on the dollar as more countries move away from dollar-based trade. We're going to see central banks continue to buy gold aggressively, which is going to put a floor under the price and push it higher. We're going to see supply constraints in silver get worse as industrial demand continues to grow while mining supply stagnates. And we're going to see a growing recognition among retail investors and institutions that precious metals are not just a hedge, they're a necessity. The price movements we've seen so far are just the beginning. Gold breaking through its old all-time highs is significant, but it's not the end of the move. If we see a real crisis of confidence in the dollar, gold could easily go to $3,000, $4,000, even $5,000 an ounce. Silver, with its smaller market and dual demand drivers, could see even more explosive moves on a percentage basis. But here's the thing. By the time the mainstream media is talking about this, by the time your neighbors and coworkers are rushing to buy gold and silver, it's going to be too late to get in at reasonable prices. The premiums are going to be sky high. The wait times are going to be measured in months, and you're going to be competing with millions of other people who suddenly realized they need to protect their wealth. The smart money is positioning now. They're not waiting for confirmation. They're not waiting for prices to break out to new highs. They're accumulating quietly, methodically, while prices are still relatively reasonable and physical metal is still available. They understand that in a crisis, availability matters more than price. It doesn't matter if gold is at $2,000 or $3,000 an ounce if you can't actually get your hands on physical metal. Think about what happened during the pandemic. When lockdowns started and people got scared, there was a run on physical gold and silver. Dealers sold out. Premiums spiked to 30, 40, even 50% over spot price, and that was just a temporary panic. Imagine what happens in a real monetary crisis when people aren't just scared about a virus, but about the stability of the entire financial system. There's also a generational wealth transfer happening right now that most people aren't paying attention to. Baby boomers, who control the majority of wealth in Western countries, are starting to think seriously about preservation rather than growth. They're not looking to double their money in the stock market. They're looking to make sure they don't lose what they've spent a lifetime accumulating. And more of them are realizing that traditional portfolios of stocks and bonds aren't going to cut it in the environment we're heading into. At the same time, younger investors who've grown up in the era of quantitative easing and zero interest rates are deeply skeptical of the traditional financial system. They've seen the 2008 financial crisis, they've seen the pandemic response, they've seen the explosion in government debt, and they don't trust that the system is stable. Many of them are turning to alternatives, whether that's cryptocurrency, precious metals, or other hard assets. This convergence of older investors seeking preservation and younger investors seeking alternatives is creating a massive pool of potential demand for gold and silver. And unlike previous bull markets in precious metals, which were driven primarily by inflation fears or geopolitical crises, this one is being driven by a fundamental loss of faith in the existing monetary system. Let me give you one more historical parallel, and then I'll bring this home. In 2008, during the financial crisis, gold was trading around $800 an ounce. Over the next 3 years, as central banks around the world responded to the crisis with unprecedented money printing and zero interest rates, gold went from $800 to over $1,900. It more than doubled in just 3 years. But here's what's different now. In 2008, central banks still had tools. They could cut interest rates. They could implement quantitative easing. They could bail out banks. Today, those tools are either exhausted or politically impossible to use. Interest rates are already low. Central bank balance sheets are already bloated. Government debt levels are already at crisis levels. If we have another major financial crisis, central banks are going to be forced to print money on a scale that makes 2008 look like a warm-up act. And when that happens, when people see trillions of dollars being created out of thin air to bail out failing institutions and fund government deficits, the flight to hard assets is going to be unlike anything we've seen before. Gold isn't going to double. It's going to triple or quadruple. Silver, with its smaller market and supply constraints, could see even more dramatic moves. The question you need to ask yourself is this: are you going to be positioned before that happens? Or are you going to be one of the people scrambling to protect your wealth after the crisis has already started? Because I can tell you right now, the people who wait are going to pay a much higher price, both in terms of the cost of the metal and in terms of the wealth they lose while they're waiting. This isn't about trying to time the market perfectly. This isn't about trying to buy at the absolute bottom and sell at the absolute top. This is about recognizing a structural shift in the global financial system and positioning yourself accordingly. This is about understanding that the rules of the game are changing, and the strategies that worked for the last 50 years aren't going to work for the next 50. The mass panic I'm talking about in the title isn't some hypothetical future event. It's already starting. You can see it in the central bank buying. You can see it in the supply constraints. You can see it in the premiums on physical metal. You can see it in the moves by countries to de-dollarize their trade. The panic is happening in slow motion right now, and most people don't even realize it because they're not paying attention to the right signals. But it's going to accelerate. And when it does, when the average person finally wakes up to what's happening, the rush for the exits is going to be chaotic. The people who are prepared, who have already taken steps to protect their wealth, are going to weather the storm. The people who aren't, who kept all their wealth in paper assets denominated in depreciating currencies, are going to watch their purchasing power evaporate. So here's my final warning. Don't wait for the mainstream media to tell you it's time to buy gold and silver. Don't wait for your financial advisor who's probably incentivized to keep you in stocks and bonds to give you permission. Don't wait for prices to break out to new highs before you take action. By the time all of those things happen, you'll have missed the opportunity to position yourself at reasonable prices. The window is still open, but it's closing. Physical metal is still available, but supplies are tightening. Premiums are still reasonable, but they're starting to creep up. The smart money is moving now, quietly, without fanfare. The question is, are you going to join them? Or are you going to be one of the people looking back in a few years, wondering how you missed the most obvious wealth preservation opportunity of your lifetime?